Okay, so about 4 years ago, an investor kicked off this really cool mission to take just $100 and figure out the absolute best way for a beginner to invest it. And today, we're going to break down the results of that entire experiment.
You know, it's that classic question that gets so many people stuck when they're starting out. There are so many options. Where do you even begin? Well, this whole explainer is about finding a clear answer to that. The setup? I mean, it couldn't be simpler. $100 split 5 different ways and then just left alone for 4 years to either grow or, well, shrink. No complicated strategies, just a straight-up, real-world showdown to see what happens.
Now, to keep this a fair fight, we're going to judge each investment on 5 key things. How hard is it to actually learn this stuff? Can it make you money while you're just holding it? How good is it when tax season rolls around? What's the real risk of losing your cash? And of course, the big one, the final results after 4 years.
So here's our game plan. We'll start by looking at active investments like stocks and real estate. Then we'll jump into alternative assets like crypto and gold, follow that up with passive index funds, and then we'll get to the final scorecard.
All right, let's start with the hands-on approaches. The investments that kind of require you to do a bit of homework.
First up, individual stocks. This is probably what pops into your head when you hear the word investing, right? You're basically buying a tiny, tiny fraction of a company, and you're betting that it's going to be successful in the future.
And you can see the trade-off right here. On one hand, yeah, stocks can be great for taxes, and you can get some passive income from dividends. But on the other hand, the learning curve is really steep, and the risk of losing it all, it's high.
So for this experiment, the stock wasn't carefully picked by some Wall Street genius. No, it was literally chosen by throwing a dart at a board full of company names. So did this crazy game of chance actually pay off?
Ooh, yeah, that's a definite miss. After 4 years, the $100 put into Samsung stock was down over 32%, even after you count the few cents it made in dividends. This is the harsh reality of trying to pick winning stocks.
And this just shows you the other side of that coin. I mean, if that dart had landed just a little differently, this would be a completely different story. $100 in NVIDIA would have turned into almost 1,000. That is the very definition of high risk, high reward. Okay, let's move on to our second active investment, REITs. The easiest way to think about it is like this. Instead of buying a whole building, you're just buying, the front door, maybe a window, and a few bricks. And you get to share in the rent money with everyone else who owns a piece.
REITs are a little more balanced. The risk is medium, the learning curve is manageable, but the real standout feature here is passive income, because REITs are actually required to pay out most of their profits to you, the investor.
So did this more stable approach to real estate deliver a solid return? Let's take a look.
Hey, a positive result. The value of the REIT itself actually dropped a tiny bit, but thanks to the dividends paid out from all that rental income, the investment ended up with a respectable 10.5% gain. Not bad at all.
All right, now we're venturing into alternative assets. These are the investments that kind of march to the beat of their own drum.
First up, cryptocurrency, specifically Bitcoin. This is that digital money, famous for making some people incredibly wealthy and, on the flip side, famous for its wild, completely unpredictable price swings.
And yeah, the scorecard for crypto is a mix of extremes. The tax efficiency is pretty poor, and the risk level is cranked all the way up to very high. The main takeaway here is you need a really strong stomach for this one.
This is the one everybody's waiting for, right? Did the high-risk gamble on the world's most famous cryptocurrency actually pay off? Oh, it absolutely did. A staggering 552% return, turning that $100 into over $650. But, and this is a huge but, this kind of growth is not normal. It is a perfect example of that extreme volatility we just talked about.
And now for something completely different, gold. For thousands of years, it's been the go-to asset for protecting your wealth, kind of like a safe harbor in an economic storm.
Gold's report card reflects its role perfectly. It has zero passive income. I mean, it just sits there. But it's really easy to understand, and its risk level is pretty moderate. It's built for preservation, not for aggressive growth.
So after Bitcoin's wild roller coaster ride, how did the slow and steady approach of gold do over the same 4 years?
You know what? A very solid performance. A 40% gain is nothing to sneeze at. This shows gold doing exactly what it's supposed to do, steadily protecting and growing wealth without all the drama.
And finally, our last contender. This is the favorite of many long-term, hands-off investors.
Meet the index fund.
Instead of trying to pick the one winning horse, you're just betting on the whole race. By buying an S&P 500 index fund, you own a tiny piece of the 500 largest companies in the U.S. It is the ultimate set-it-and-forget-it strategy.
I mean, just look at this report card. Low learning curve, low risk, great tax efficiency, and moderate passive income. On paper, it's pretty much an all-star.
We've seen a big loss, a small gain, a huge gain, and a solid gain. So how does simply betting on the market as a whole stack up?
A fantastic result, a nearly 80% return, turning $100 into almost $180. This really demonstrates the power of consistent, diversified, long-term growth.
Okay, time to bring it all together and see how these 5 really stack up against each other.
And here it is, the final scorecard. Look, crypto was the undeniable winner on pure returns, no question. But it also came with the highest risk and the worst tax rating. The index fund, on the other hand, offered the best blend of strong returns, low risk, and simplicity. The stock pick was a bust, while REITs and gold delivered, modest and solid returns.
So what's the most important lesson from all of this? It's not about trying to pick the next